Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending November 18th. Let's go ahead and start out with our cryptocurrency charts, starting out with Bitcoin. So Bitcoin's been in some sideways price action for the week after a pretty big drawdown the previous week. And currently, as I'm recording this on the 20th, looks like we are heading down a little bit, but still trading within this kind of sideways price action on Bitcoin. We'd be looking for a clear break below 15,800. If we're looking to enter a new short, if you're currently already in this short, then you're potentially fine, but I would watch for it holding support at that 15,800 to 16,000 level. And if you were looking for a long opportunity, I'd want to see Bitcoin get above that anchored VWAP position again, which is just below 18K. But as we're currently sitting between about 15,800 and 18K, that looks like primarily just kind of some sideways price action in Bitcoin. So if you're looking to enter a new trade, I'd be waiting for either a break below that 15.8 to go short again, or I would be looking for a break above 18K if we're looking to go long at this point. But right now, just a lot of sideways choppy action in the cryptocurrency space. And let's take a quick look at the Ethereum chart as well. Ethereum's also down a bit on the day as we recorded this on the 20th. But before that, we were looking at pretty much some sideways price action at Ethereum as well. And the levels I'll be watching on Ethereum to take some further action would be, I'd be wanting to see some close below the 1100 level in Ethereum. If I was going to enter a new short with the downside price target right around the anchored VWAP, which is just below 900 currently. Or if we were looking for a long setup in Ethereum, I want to see us get back up above that $1,400 level for a potential breakout. But I think right now it's definitely, I'm being more cautious in the cryptocurrency space, so I'm either sitting on the sidelines or looking for some tactical short trade opportunities. I really want to see some of these cryptocurrencies get back up above some key moving averages and some key areas of support and resistance before I'd be looking to re-enter some longs in this space right now. So let's dive over to the traditional market, starting out with the S&P 500. S&P 500 had fairly choppy price action on the week. Looks like it is somewhat setting up as potentially a bit of a bull flag or bull pennant. And as long as we're sitting above 390, I think you got to stay pretty bullish in the market. And it looks like we did drop down on Thursday and ultimately tested that 390, which is where we opened the market on Thursday, but then we saw a pretty nice rally back up to the 150-day moving average, and then Friday we ultimately closed higher. And while we did sell off a little bit on Friday in the S&P, we did put a nice hammer candlestick in to close the week, and we ultimately closed above that 150-week moving average. So some of the next price targets to the upside I'll be watching for is that 200-day moving average, which I think we'll likely be testing here fairly soon, and then also this down channel trend line. This has been in place since looks like January, late December, early January of last year, and then beginning of this year. And so that's been tested 3 times now in the calendar year of 2022. And each time we've hit it, it's been a pretty big sell-off after that. So that'll be a really important trend line to watch closely on to see how price action reacts around that level. And so watching for that 200-day moving average and this trend line will be really key, in my opinion, to kind of see where markets head from here. And if we certainly see a breakout above both those 2 levels, then I think that'd be pretty bullish for the markets. And we'll likely continue to see a rally even higher than a lot of people are expecting. But we do need to first contend with both that 200-day moving average and that trend line first. And then we've also got some pretty strong volume support and resistance right around that 414, 415 level, which is also an anchored VWAP extension level too. So there's still some pretty big multiple areas of resistance we've got to get through. But overall, I think this rally still looks like it potentially has legs, and we could potentially see the markets head higher going forward into the coming weeks. And then take a look at our S&P market breadth. We've got about 56% of our S&P 500 stocks above their 200-day moving average, and it looks like they're just kind of hanging out in a fairly tight bull flag there. And then same with the 50-day, we've got a nice little bull flag for our 50-day moving average percentages. They're sitting currently at about 83%. So both of these are looking like they're doing a bit of consolidation, and typically after you see a consolidation pattern like that resolve, it's typically to the upside from here, and so things are still looking pretty good from a breadth perspective as well in the markets. And then taking a look at our NASDAQ, our triple Q chart, we did get back up above. We ultimately opened Thursday, which was low on the week, below an anchored VWAP position, but we pretty quickly got back up above those levels. And then Friday opened higher, just like the S&P did, and then ultimately sold off a bit, but it still held above some pretty key levels. So we've got looks like about 282.23 and 282.35, so both just a matter of pennies within each other. We've got a Fibonacci extension level as well as an anchored VWAP position that it ultimately closed above both of those on Friday. So I think that's, at least in the short term, fairly bullish for the NASDAQ. And I think at a minimum we'll likely see the NASDAQ get back up above those levels, back to this down channel trend line or this 200-day moving average. And then I think that'll be a really key area to watch for on the NASDAQ. The NASDAQ has been beat up much worse than the Dow or the S&P 500 have throughout the sell-off this year. And so if there's a sector that maybe could potentially fail sooner than the others, my guess would be potentially the NASDAQ. But like any of these charts, we really do need to get above that 200-day and that down channel trend line, which we're fairly fast approaching to see where we go from here for the markets going forward. Now on the Dow Jones Industrial Average, however, the DIA that we're looking at now, we have actually already cleared both of those key levels, and so we've got well above our down channel trend line, we've got above our 200-day moving average, and so things are looking much more bullish in the Dow Jones Industrial Averages. And our next area of resistance we got to get through looks like it's about 242.50, which is a Fibonacci extension level off of a previous high. And so once we get above that, if we do, that would be extremely bullish for the Dow Jones Industrial Averages. And I think if we can get some price action above that level, then I think some people will potentially start looking at whether or not we could essentially double top in the Dow Jones Industrial Averages, which would get us back to our former all-time high, which occurred at the beginning of January this year. The Dow Jones Industrial Average peaked out right around 369, just below 370 it looks like. And the way things are going right now, unless we see a major reversal in the Dow fairly soon, if this rally continues, we could potentially be set up for a move back up to do a double top on the Dow Jones Industrial Averages. But that next area of resistance we got to clear through first is that 342.50 level. And then take a look at our transportation, our Dow Jones Transportation Index. These are our weekly candlesticks. Last week we talked about how we got up to this down channel trend line as well as that 50-week moving average and kind of held there. Ultimately going into this week, we kind of chopped around up and down. We at some point did get above both the 50-week and the down channel trend line, but ultimately closed the week down below it, as well as it looks like we're slightly below that Fibonacci extension level. So we'll see if this is ultimately the start of a rejection and if the transports head lower from here, or if we potentially break out and reverse that and then head higher. So this, I think, going into next week will be a pretty important week for the transportation space. So if you're trading anything, either the transportation index itself or stocks within the transportation space, I think going into next week we'll get some key information as to where this sector is ultimately heading from here. Kind of in a bit of an indecision space, and I think this next price action we'll see next week will give us a good clue as to whether we're heading lower on transports or we're ultimately potentially breaking out and heading quite a bit higher potentially for the transports. And then taking a look at a Russell 3000 chart, we are above our 150-week moving average and below that center channel trend line, and I would expect that we'll likely retest that, and then that'll ultimately be a big kind of signal from there whether we break above that center channel trend line as well as the 50-week moving average. If we can get price action above both of those, then that would definitely be a very bullish signal for the markets, at least in the short term. And then taking a look at a Russell 1000, we got it back up above the 150-week moving average last week, and then ultimately sold off a little bit going into this week on large caps, but ultimately did hold that 150-week moving average as support, which is pretty bullish, and it was really just kind of a consolidation week after a big move to the upside. So I would still think my bias would be probably to the upside for large caps, and the next big test to the upside on large caps will be that Fibonacci extension level at about 231, and then that's also coinciding with both our 50-week and our 100-week moving averages, which are both just below and above that level. So that'll be a pretty key area of resistance to test on a Russell 1000 for our large caps. And if we can see price action get above that Fibonacci extension level as well as those 2 moving averages, then that would be a pretty bullish signal for large caps in the short term. And then taking a look at our Russell 2000 chart, small caps. We had a bit of a sell-off on the week for small caps, but ultimately did come back and retest that 200-week moving average. It did hold the support, and then we regained some of the losses on the week, but ultimately did end up just a little bit lower on the week. And then we also did move to the upside a bit, and then retested that 50-week moving average. So, and then we also got this anchored VWAP position here. So we've got multiple areas of support and resistance to kind of contend with, and so we really need to see a resolution of an either breakdown below the 200-week if we're looking to go bearish for small caps, or we would like to see some price action get back up above that 50-week if we're looking for some long opportunities in the small cap space. And then taking a look at our growth versus value chart, growth had a big week the previous week relative to value, but then this week we ultimately settled back into the larger trend and value outperformed growth. And then when we take a look at our sectors that we track over the last 5 trading days, last week when we looked at this, I think almost everything was green just about. And ironically, last week I believe the United States Natural Gas Fund was one of the few spaces in the red. It looks like to me that United States Natural Gas ETF, ticker UNG, may have been doing a bottoming process after a pretty big sell-off, and so we'll get to that chart in a minute, but that was our best performing sector on the week. Solar also did relatively well with about 2.6% of upside, and then we saw consumer staples, utilities, and healthcare all up about 1 to 1.5%, and then also a global clean energy up just slightly. Everything else was in the red on the week. And then at the bottom, some of our worst performing sectors, the ARK Innovation Fund was down 10%, lithium down 10%, cloud computing down 8.5%, fintech down about 8%, online retail down about 6.5%, and we saw sectors like biotech, robotics down between 4 and 4.5%. But quite a few sectors were down on the week. This was kind of a choppy week, but mostly in a fairly tight consolidation range within the major indices, and so I still think there's a good chance we head higher from here. But if you're trading a lot of things just short term, long on just the week, it was a bit of a challenging period I think for most people. But I think there's still a good chance for some upside in the broader markets going forward. So let's dive into that natural gas chart that we talked about in the sector space. Here's the chart of the UNG. I'm actually in a trade on this one, and I've been kind of looking for this bottoming process to occur. It has been very volatile, so if you are trading this one, you need to have some pretty wide stop losses on this, because otherwise you can get stopped out pretty quickly. But it does look like there's been a pretty strong attempt to kind of put in a floor here. We had a pretty massive sell-off as we ultimately were up at about 34.50 on UNG, just going back into late August. And then we ultimately saw almost a 50% sell-off in natural gas. And so a real big aggressive sell-off. We also bottomed out fairly close to the previous bottom, so it looked like it was, for the most part, a pretty solid double bottom formation starting. So as long as we are sitting below or sitting above about $18 on UNG, I like this trade long, and I think there's a decent chance we could get a pretty big pop to the upside, potentially getting all the way back up at least to that 3280 level, which is a Fibonacci extension target. And so from about 18 or so per share, that's about a 70+% move to the upside if we get that. So definitely a lot of upside opportunity in this one, and it looks to me like a bottom is being put in natural gas. And then taking a look at our U.S. oil chart, so we were fairly bullish on oil as well in the energy space, and I still am. However, oil has kind of shifted to the downside, and I was not really expecting a break below that $85 level. And we clearly did get below that going into Thursday and Friday to end the week out. But it does look like we potentially put in another short-term bottom in oil, put in a bit of a hammer candlestick on Friday the 18th, and ultimately closed oil on the week at about $80 a barrel, ultimately putting in a bit of a double bottom right around that $76, $77 level. And so as long as that holds, then I think there's a pretty good chance that we head to the upside from here on oil. If we did see a break below that 76.50 level, then that would definitely be a change in plans, I think, for my energy trades. But for now, as long as we're holding that 76.55 level, then I think there's still a good chance that the energy trade will be intact, and there'll be plenty of opportunities to go long in that space, as long as we see it hold that 76.50 level. So from here, it's looking like there's a good chance we'll hopefully be heading back up to the upside on this for the energy trades, and potentially looking for getting back up to $90, $100 a barrel, and kind of see where things go from there. And then taking a look at our commodity chart, the CRB index had a pretty big development on the commodity space on the week. We were getting back up into this trading channel line that we've been in for quite some time, going all the way back to the COVID lows. And it looked like we were trying to attempt to kind of get back up into that trading channel, and that certainly would have been a pretty bullish development, but ultimately that did fail, and we turned back and reversed down to the downside. We ultimately lost that channel line as well as the 50-week moving average, and looks like CRB is heading lower, closed the week out at just above 276 on our CRB index. So as long as we're below that 50-week moving average, then you've got to be fairly bearish, I believe, on the commodity space, as long as we're below that range. And I think at least from the inflation narrative side of things, if CRB continues to drop, that's probably a good thing for our economy and for the markets longer term. So we'll see where we go from here on the CRB index. It's definitely been fairly choppy over the last couple of months. We did, it looked like, put in a bottom at that 267 level, so I think we do need to see a break of that 267 level on CRB to get really bearish. But I think if price action gets below that 267 level, then that could set us up for a decent short in the CRB space as well. But for now, I'll probably be watching this one and to see if we do get a break below that, because that's less than $10 below where it's at right now in the CRB index, and so I'd probably be looking for a drop below that 267 to actually enter a short on it, but I also wouldn't be looking for any longs at this point on CRB. And taking a look at our VEU, our World Global Index minus the United States. Talked about last week a big break through that trend line, which we had not broken since really the beginning of the sell-off, going back into last year. And things kind of just sat around fairly neutral on the week. Some decent volatility both to the up and downside on global markets, but ultimately settled just slightly below where they closed the week before. So a bit of an indecision week on the markets for the global space, and we'll see where we head going into next week there. And then taking a look at our high yield corporate bond index, HYG. We talked about needing to get above that 75.11 level. Ultimately that didn't happen this week, but it did not really sell off a whole lot either, and so it's hanging out pretty close to those levels. I think there'll probably be an attempt to get past that area of resistance at the 75.11, and if we do see it get above those levels, then we'd be looking for maybe a retest back up to 79.50 on the HYG, or at least a retest of the 50-week moving average, which is currently sitting at about 78.50. And then gold and silver, our precious metals, starting out with gold first. We had two strong weeks, a big rally out of gold, but then it ultimately got up to this volume resistance right around 167 or so on the GLD, and then sold off a bit on the week. And for gold, for me to probably look for a long trade, I'd want to see, since we're so close to the tops of these moving averages, I'd probably want to see us get above those for me to get a little more bullish in the space. So if we see price action above about 168, 169 on the GLD, then I think there'd be some potential long opportunities on gold. But for now, it looks like we might be seeing some price action in between that 200-week and the 50-week. And since they are fairly close together, I'd probably want to see some sort of resolution on that, one way or the other, to the upside or downside before I enter a position on gold. But things are definitely starting to look a lot more exciting in the space for precious metals than they were really all of this year. 2022 is not the time to be going long on precious metals, but I think 2023 could be set up for a very different story. So I'm watching the precious metal space very closely going forward. And then take a look at silver. So our SLV chart, similar story. We got up to that 50-week, ultimately failed on that, and then headed lower. We did close slightly below the 200-week moving average, and so similar story to silver as gold. I'd want to get back up above that 200-week and the 50-week on SLV, and then if we see some price action hold above that 50-week moving average, then that could be a decent setup to look to get in a long trade on silver. And then take a look at our interest rates. Our 2-year closed the week out at just above 4.53%. We ultimately came down and retested our 10-day exponential moving average. That held as support, and then we headed higher. Closed the week up just above 4.5% on our 2-year. And then our 10-year, we actually got below the 10-day 10-day EMA, but ultimately did retrace most of those losses on the week and came back up and settled just above the 10-day EMA for the 10-year interest rates. Currently closed the week out at 3.83%. And then our 30-year interest rates also got down just slightly below the 10-day EMA, and then ultimately closed just at those levels, currently sitting at just below 4%, 3.93% on our 30-year. And then taking a look at our VIX. Our VIX did have a bit of a spike going into last week. We got all the way up as a little bit above 26 on the VIX, but then that was pretty short-lived. Ultimately ended the week out closing the VIX at about 23 or so. So the VIX is still staying fairly low, especially based on the quite a few days that we've had this year in some pretty elevated VIX ranges. We spent a lot of the year above 25, not a lot of the year below that, and so we are currently sitting below 25, and I think there's a good chance we'll get back down to the 20 levels and likely retest that. And so we're seeing some lower volatility levels that we've typically seen for most of the calendar year in 2022. And then our put call ratio is looking pretty good, fairly normal levels. We're below the 1, so there's not elevated put buying production in the markets currently, and we're sitting at 0.897 on our put call ratio currently. So nothing too extreme on either side of the coin there. And then taking a look at our DXY chart, we talked about the dollar very much on this channel and how important the dollar's been for the markets. And we did see a big sell-off in the dollar. Ultimately, a lot of people started, I think, talking about the demise of the dollar and that the top of the dollar was in. However, I think this was just more of a correction in the dollar, and that we still do have potentially another leg higher that could get us back up above 115. And it does sort of look to me like, looking at this chart here, that big hammer candlestick we put in, looks like it was back on Tuesday of last week. Potentially could be the bottom. It didn't quite hit the 200-day moving average, but it got pretty close. And the rest of that price action ultimately is sitting at this 61.8% retracement level from this last move to the upside, which is sort of what we were looking for a potential bottoming process in this correction. And so we'll see where we go from here on the dollar, but from what I'm seeing on these charts, it looks like there's a good chance the bottom is in on the dollar. But we also could chop around for a bit still on this one. So just because the bottom is in doesn't mean we're going to just naturally rocket right back up to 115 and higher. There's a decent chance that we chop around some more for a bit, and even just a kind of a slowed down dollar that doesn't have quite the volatility we've seen this year, and just kind of seeing some more sideways price action of the dollar, I think could still support some rallies in the market. But if we do start to see a really rapid rise in the dollar once again, then I think that is a warning signal to get cautious, because that could be not good for the markets if we do start to see that aggressive move to the upside in the DXY. But for now, things are looking fairly calm in the dollar at the moment. And then taking a look at our 10-2 and our 10-3, so these are yield curve charts. The 10-year minus 2-year is at a historic level. We've never been at this level, negative 0.708. That is the most negative reading we've ever seen on this. So while things I think in the short term are good, this chart keeps reminding me that we likely are going to have some additional selling in the markets, and a recession is extremely likely. And so we need to be cautious with our investments and our trades out there when we're seeing really negative readings like this. And then when we look at our 10-year minus 3 months, we're also at some very extreme negative readings, negative 0.319% to close the week out. And when we look at the bottom on this one, the last time was back in September of 2019. We put in a negative reading of negative 0.465, which ultimately looks like where we were at just this last week as well, but then it did pop up from that level a bit. So I'm not really sure if we've ever been more sold off on that reading as well. It doesn't look like we have. So it looks like on both of these yield curve charts, we've got some of the most extreme negative readings across the board. And so these definitely both should be some strong signals and warnings of what's to come in the future. So thanks for tuning in this week. Make sure to download the ToroAlerts app on the App Store. We've got one for stocks and we've got one for crypto. Give this video a like and a share, and we will see you next time.